Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Thanks for joining us at lunch. This is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Stocks rise for the second straight day following gains in Asian counterparts as well after Wall Street posts the sharpest intraday rally since 2009. Former RBI Governor Bimal Jalan will head a 6-member panel to set up the review of central bank's economic capital framework. The government bars deep discounting, exclusive tie-ups and private labels for foreign e-commerce companies. New rules come into effect 1st of February. Vedanta will invest $8 billion to expand crude oil and metals production in India over the next 3 years, says Chairman Anil Agarwal. Well, also on the show, we're going to be talking to Autocar editor Hormazd Sorabjee on what's in store in the world of automobiles in 2019. We'll get to all of that. Well, let's talk about what's been for the markets in store. You've had a bit of confusing signals from global quarters. What happened in the last couple of days have been reversed yesterday and this morning. That's reflecting in some part of the market today as well. Neeraj is here with a closer look of how 2018 is likely to end.
Yeah, well, if Europe is to be believed today, maybe with a bit of a bang as well. But yeah, you're right. Very conflicting signals from the world markets. Thankfully, India has been a lot more resilient. So we ended about 1% higher in trade yesterday itself. And therefore, maybe just a 0.5% move today. In stark contrast to what some of the other Asian peers have done, particularly the Nikkei. But the banks have completely quietened down today. So very, very flat in the session today for the Nifty Bank. And largely the index is held out by what's happening to IT and what's happening to Reliance. To be honest, if you just look at the top 5-6 gainers, Infosys, TCS, Reliance Industries, and you know why is it that the index is doing what it is doing. Banks are not falling off, which is also aiding the move, but it's essentially IT and Reliance Industries which is holding the index higher in trade today. There it is, 2% for Reliance, Nifty IT doing well. You have the index doing okay for itself. At the broader end of the spectrum, fair degree of divergent movements. Motilal Oswal is up 5%, Edelweiss is up down about 3-odd%. Cement names by and large have corrected, save for one or two. So Ambuja, Ramco, Shree Cement, etc. That entire clutch of stocks, which was up and active yesterday, has come off in the session today. So it's fairly mixed bag. The market breadth is also fairly ordinary, but the volumes today will be higher, Harsha. FNO expiry, so naturally you will see that the volumes are higher. The market may be okay, but the volumes certainly much higher in trade today, at least the FNO volume. So that's something to watch out for. But hey, just to end, since you brought 2018 into picture from the peak, Nifty 8.5% down from the peaks. S&P after this 5% up move yesterday, still about 14.5.
Correct.
Shanghai 28, Kospi 22. So
let's get this over with. All right, that's the markets for you, hoping for better 2019. But let's move on and talk about what's going on in New Delhi. Representatives from the NBFC and the housing finance industry met with the Prime Minister on Wednesday. The delegation sought easier regulations to help deal with the liquidity issues that they're still facing, it seems. Vishwanath is here with some of the what the industry really wants from the government.
It's a long list, Harsha, honestly, because so when they highlighted their issues to the Prime Minister, the industry delegates, they pointed out that this was largely because the regulator has moved the regulations for the NBFC industry closer to banks, which means that there has been a lot of focus on the asset side of the business, but the liability part of it remains largely unregulated, because of which there is a funding crunch sort of situation. What they seem to suggest is that there needs to be a special liquidity window that the RBI must introduce, where NBFCs and well-rated housing finance companies can pledge their loans and gain some kind of liquidity. They are also seeking the exposure, BFSI exposure that insurance companies and pension funds have, those be raised so that these companies can invest more in housing finance companies as well as NBFCs. They're also seeking that the current asset liability norms of the RBI, which are in place right now, should not be tightened any further, and that this should be maintained so that their liquidity issues are in balance. Of course, all of these are a number of things that they're asking from the government, basically easing the regulations around the NBFC business so that they can continue and have a healthier business. Remember that this problem started with IL&FS.
Correct.
After the defaults, the entire credit market got a little spooked. People were finding it difficult to raise money, but that has continued since, because since then there have been multiple instances where banks and other investors and other creditors, they've refused funding to lower rated companies because they feel that probably it's at a higher risk at this point in time. Because of this, there's been a clear funding crunch, and now these problems have arisen.
They've sought the intervention of the Prime Minister. That's the NBFCs. Hold that thought, Vishy. The government and the RBI may be one step closer to resolving the biggest bone of contention between them, and that's the issue of capital. The central bank has constituted a committee to review its economic capital framework. That's headed by the former governor of the Reserve Bank of India, Dr. Bimal Jalan. Vishy, explain, who all are there, what are they expected to do?
So apart from Bimal Jalan, there's also former Deputy Governor Rakesh Mohan. There are 2 central board members. There's also Subhash Chandra Garg from the government, and we have the current Deputy Governor of the RBI, N.S. Vishwanathan. All of these people will be working together to come up with a new economic capital framework. Remember that the RBI has had an economic capital framework, but that has so far been sort of secret. It's not in the public domain, and the RBI decides how much, what level of reserve it must maintain, and then pushes off the rest of the amount as surpluses to governments. But what the government has said is that there's about 3.6 lakh crore worth of excess capital that the RBI is sitting on, and that should ideally come to the government. Now this committee will assess, firstly, what is the level of surplus that the RBI holds. Secondly, whether this is at an appropriate level or not. And if it is in excess of the appropriate level, then what needs to be done with that fund. Remember that this decision to create an economic capital framework committee was taken in November during the central board meeting that took place between the board members. And after that, of course, we've seen a high-profile exit at the RBI with Urjit Patel leaving. There are talks that this was because this issue came to head and the RBI and the government could not see eye to eye on this matter, and that's why the governor left. Of course, we don't know. But yes, creation of this committee and the work of this committee will be important in telling how exactly the RBI deals with its reserves.
Do we know timelines?
We know that it needs to submit its report. The committee needs to submit its report within 90 days of its first meeting. And when the first meeting takes place is something that we have to see.
Okay. Vishwanathan, many thanks indeed for joining us with those details. That's the RBI capital framework, or at least the committee that's been formed. We'd in fact spoken to one of those members of the committee, former Deputy Governor of the Reserve Bank of India, Dr. Rakesh Mohan, on this issue on the 31st of October. He was very clear that the RBI needs to factor in 5 possible risks before it transfers its entire profit to the government. Listen in.
The issue needs to be divided into 2. One is to do with the transmission of dividend and what proportion of profits of the Reserve Bank ought to be transferred to the government. The Act makes it clear that all the profits of the Reserve Bank have to be transferred to the government. But of course, there can be an issue of what those profits are as an accounting issue. And it is clear that given the risks that the Reserve Bank undergoes, that it's important for the Reserve Bank to make provisions for various contingencies. And those contingencies, as I've mentioned in my article, include at least 5 possible risks. First, the appreciation of the rupee against other currencies on a possible fall in gold prices with respect to the rupee can lead to rupee losses. Second, possible fall in the value of the bonds that the Reserve Bank holds can also, of course, lead to losses on account of rising bond yields. Third, sterilization costs relative to open market operations and other innovative means also can lead to losses. And of course, possible credit risks arising from any lender of last resort for operations. And of course, any other risks that may arise because of unexpected increases in expenditure. Like, for example, there were large increases in expenditure as a consequence of demonetization in 2016-17. So there's a number of risks that the Reserve Bank has, and it is prudent accounting to make adequate provision for coping with these risks. There can be a difference of opinion in how you do that, how much provisioning you do, etc. What the Reserve Bank has done over the years is that it has appointed from its board a succession of committees to devolve a procedure for deciding on how much provisioning it ought to do, and then, of course, after the provisioning, transferring all the funds, all the profits to the government. Therefore, in some sense, as far as the transfer of dividend is concerned, what needs to be done is to really have an agreement on what kind of formulae that should be used to decide on the kind of provisioning that is necessary for the functioning of the Reserve Bank. And such provisioning adds to the confidence that the markets have in the functioning and strength of the central bank. So that's one. That is, just to repeat, that it is useful to have a relatively clean formula by which this decision is made. As I said before, there have been a number of committees, high-ranking committees. I think if I remember correctly, two of them were chaired by Mr. Malikam, who is among the most respected accountants in the country, both internationally as well as domestically. So that kind of the decisions of those kind of committees ought to be respected, and then there should not be much cause for differences.
That's Dr. Rakesh Mohan, former Deputy Governor of the Reserve Bank of India. In an attempt to safeguard domestic retailers, the government has notified stricter norms for foreign e-commerce players in India. The new framework bars exclusive tie-ups, private labels and deep discounting. That comes into effect from February. Charlene D'Souza now joins us with more details on this one. Charlene.
Okay. The government on Wednesday announced certain changes to the e-commerce policy. Now, this will make it difficult for you to find the latest OnePlus mobile sold exclusively on Amazon or on its website. Is the other place where you could find it. Now, it states that an e-commerce marketplace cannot mandate a seller to sell exclusively on its platform, and has also clamped down on deep discounting. Now, the press note also makes it clear that any services provided by an e-commerce marketplace entity should be at arm's length and in fair and non-discriminatory manner. This applies not just to services such as logistics, warehousing, etc., but also to cashback schemes. The regulation also makes it difficult, if not possible, for e-commerce companies to sell private labels if they own a stake in those companies. Now, private labels typically offer e-commerce companies the opportunities to fill product price gaps and earn higher margins than compared to the brands owned by other companies. Now, Amazon said in its statement that they are still examining the implications of these new rules, while Flipkart was not available for comment.
Charlene, thank you for that. That looks like a beginning of a battle between the e-commerce players and the government, but we'll keep a closer tab on that one. Hindustan Unilever, meanwhile, is considering legal options against GST anti-profiteering body's order. The National Anti-Profiting Authority had imposed a 223 crore penalty on HUL for not passing on rate cut benefits to consumers. In a statement last evening, HUL said that the order makes a narrow interpretation of the law and does not take into account well-established industry practice backed by law. Talk about aviation now. Rising jet fuel prices, moderation in passenger traffic growth and deep discounting. Indian Airlines have not had it easy in the last few months, but a recent report by Kotak Securities suggests that they've finally decided to bite the bullet and hike prices. Somit is here with the details on what this means for the industry, and clearly not good news for the consumer.
Well, yes, it is not a good news for the consumer. So if you see, Kotak has come out with this note where they're expecting a steady rise in the ticket prices now going forward for the aviation industry. Now, they believe that earlier airline companies were using pricing as a technique to grab travel market share from Indian Railways, and they have been successful in doing so. If you see, the air travel market share has increased considerably in the incremental trade volume place, where it was around 28% back in 2014 to it has increased to around 81% in 2018. And if if you see the air travel volume numbers, you can clearly see a divergent trend coming in there. Now long distance AC rail, now over 2010 to 2014, the growth was around 13% for long distance AC rail, and for domestic air travel it was around 9%. But over 2015 to 2019, the growth for air travel is expected to be around 19%, while that of long distance AC rail is expected to be only 5%. Now this market share increase and higher volume growth will definitely benefit the aviation sector, and in the aviation sector it will benefit Indigo the most, because if you see that company has increased its market share rapidly in this period, from around 28% back in 2014, its market share now stands at around 43% in 2018. So there is no doubt that Indigo will be benefited the most out of this. Now the steady rise in ticket prices will also help the aviation industry to make profits going forward, because the last time when we saw them getting involved in price wars, the entire industry had suffered with massive losses. So the combined losses in the last 3 quarters was more than 4,800 crore for just 3 listed airline companies. So you can see the kind of impact that these companies had seen because of price wars. So steady hike in prices would be the best way going forward for the aviation industry. Now the only challenge that the industry would face due to higher fares would be lower passenger growth, and we are seeing some signs of this so far in the 3rd quarter of financial year 2019. If you see in October, the passenger growth was only 13%, while in the month of November, which was the holiday month, the passenger growth was only 11%, which was the lowest in at least the last 4 years. Now Kotak believes that this is a sign that there cannot be any incremental market share gains for aviation industry from Indian Railways, and that's the reason why the passenger growth has been moderated. However, this will definitely impact the industry on the other hand, because they have already placed large aircraft orders for Indigo. If you see, they have placed an aircraft order of 430. Jet Group has 225 aircraft orders already placed, while that of SpiceJet is around 155 and that of Go Air is close to 144. So because of this large aircraft order and lower passenger growth, the occupancy will definitely come down, which will have some impact on the financials of these companies.
Soumya, thank you for that. That's the situation in the aviation industry. I'm going to shift focus and talk about automobiles. Automakers were hoping to ride the boom in 2018, but it did indeed play out that way in the first few months of the year before turning south. That's prompted automakers to turn to discounting even on some new launches. But 2019 is a new year and car makers are only adding to their offerings. So will that help cushion the fall? Joining us to talk about it and what's in store for 2019, Hormazd Sorabjee, editor of Autocar India. Hormazd, pleasure having you as always. Firstly, how would you characterize the year gone by, both in terms of products that we've seen in the market and consumer demand?
Well, I think, I think the year started off quite well. There was pretty good demand, but as you said, towards the end, the demand has really tanked. And I think multiple reasons for that. Obviously, fuel prices play a big role in that. The fuel prices just skyrocketed. The rupee depreciated. So all these factors generally have created a kind of a, I wouldn't say a bit of a panic, but people have kind of put their car purchases on hold. I think also if you see the new launches, there have been very few big launches in the mass market. You've had cars like the Hyundai Santro, you had the Swift earlier, but I think beyond that, it's been one of those years where there's not been really any major big ticket launches. So I think it's a combination of all these factors, and of course as we come to the end of 2018, clearly it's a very difficult market. Even the luxury end, which was growing quite a bit, that's also seeing it's a very small base, but even off that small base where you would expect a lot of growth has been quite small. So I think across the board the sentiment has been pretty down. And I think we've been seeing some trends emerging, though the SUV segment, which is again let's say the hottest segment in the market, I see that kind of softening a bit, because again the impact of fuel prices is going to maybe drive people back a bit to hatchbacks. And also I think in 2019 we're going to see some key models being launched. We have the new WagonR, which is coming on Jan 23rd, and we will be seeing a lot of products being refreshed, because you've got crash safety norms coming in, for which you need a new model lineup, because some of the old existing ones will have to go and new ones will have to come. So I think 2019 there will be more models coming in, and probably I think it should be a better year.
What to your mind would be the most exciting or the most sort of sought after product segment to look out for, where product launches are likely to be more?
Well, I think, I think 2019, we're going to see some really key products. You've got the Tata Harrier, which is being launched on the 23rd, coincidentally with the Wagon-R. So two real heavyweights in their own segment, in the sense a lot of interest around the Tata Harrier. Of course, it remains to be seen how a 20 lakh Tata car will work in the market. It will be a test of the brand, but I think early indications show that the response has been very good. So this product could be a game changer for Tata Motors in terms of the brand and the way it's perceived. And, if they get it right on this, then, the brand will really have come of age. So that's really something everyone will be watching. A Wagon-R is always a huge seller. So you've got an all-new Wagon-R coming, one which meets the new safety norms as well, which are, coming in October 2019. So that's going to be a big volume seller. You've got the new Hyundai subcompact SUVs, which is again going to come into the Brezza segment. You've got Mahindra coming in with the XUV 300, again car with a lot of promise. So you've got quite a range of products coming in this year in the, I would say, the sub 10 lakh segment. So when you're in sub 10 lakh segment, you're looking at bigger volumes, and obviously those volumes can grow the market. I think you're even looking at a new Alto, a new an Omni replacement, because let's not forget that all these old products, all these legacy products, they have to go because they cannot meet the new crash regulations. That means even the Tata Nano has to go eventually. Not that it was great volumes, but of course it's very significant once Tata Motors pulls the plug on that.
Sure.
So you will see a cleaning out of all the old legacy models and the new models being coming in to replace them.
What about the luxury segment, Hormazd? You were mentioning that you did see sentiment taper off even for the luxury segment in this year. Anything interesting to look forward to?
Well, I think the luxury segment, obviously the barometer of that is Mercedes, which is by far the market leader. But from all accounts, I mean, they haven't announced their sales, but what we hear is that they will better their last year's sales numbers, but not by much. They did about 15,300 last year. They were expecting to do 17,500 at the start of this year, but they've kind of rolled back on that target, and they'll probably just about beat what they did last year. So it'll be slightly flattish for them. Of course, Audi have had a lot of problems, and they've had their own challenges, more global than in India, and that's impacted them over here. And I expect Volvo to grow quite a bit, but it's a very, very small base. So even if they grow by 20-30%, it really doesn't impact much. And Jaguar Land Rover also will show some growth. But you talk to dealers, it's a bloodbath out there. I mean, the discounting on luxury cars is just massive. And they've been commoditized, and that's even impacting some of the brands. So I think a big challenge there for the luxury segment as well. And it's not that they're getting any cheaper, because, just the cascading effects of duties, especially on CBUs, just makes them more and more expensive.
One final question. This year saw the very interesting announcement in the two-wheeler space of an iconic brand like Java. What do you think are its prospects against a well-established brand in Bullet?
Well, I think, it's very interesting. Obviously, there's a phenomenal response to both products. So, it's quite interesting to know that retro is retro is such a rage in a millennial world. But I think, I think what these products bring is something refreshingly different. Obviously, let's not forget, these volumes will be very niche, very small in the overall, two-wheeler space, which, it'll be quite, in fact, even just a drop in the ocean. But I think what it does say is that, there's a lot of interest in these brands. And obviously, earlier, Royal Enfield, which was known for, let's say, having that character, the typical Enfield character, which everyone kind of bought into, but the product's not being so good. But I think for the first time, they've produced a genuinely world-class product. In fact, it's got me on a bike after almost 15, 20 years, and I've been riding that, and so it's really come out quite well. From what I understand, the Java has to, and it's got that character. It's got the legacy of the older, what the Java stood for. So I think these cars, these bikes, they stand for something, and I think that's what's really important going ahead. Because from the clutter, you've got to have a sharp brand identity, a sharp brand focus, because that's what makes you stand apart, especially in the two-wheeler space, where two-wheelers are generally just commuters and commodities.
Good talking to you, Hormazd. We'll leave it there. Thank you so much indeed for joining us, and Happy New Year to you. Hormazd Sorabjee, editor of Autocar India, talking to us about automobiles, cars and bikes for 2019. Vedanta, meanwhile, is looking to invest about $8 billion in India over the next 3 years. Chairman Anil Agarwal, in an interview to us, says the money will go into ramping oil production, aluminium and copper production as well. Listen.
We are looking to make an investment of about $8 billion. $8 billion, very excited to make $8 billion investment. We are going to make 500,000 barrels of oil. We are going to increase 1 million ton of aluminum production. We are going to increase about 800,000 ton of zinc production, silver production, iron ore production, copper production. We are doubling. With all this, $8 billion will be invested in 3 years' time, and we expect our revenue should be about $25 billion, which is, we are very excited. We definitely, and we'll be creating at least directly, indirectly, 2 million jobs.
Anil Agarwal there. Even amidst rising demand for electricity in India, many power producers have reported a marginal decline in plant utilization levels. Worse, merchant power rates in the spot market have continued to fall. Yatin is standing by to take us through the data released by the CERC, the Central Electricity Authority, to make sense of what's going on. Yatin?
Afternoon, Harshan. As you were pointing out, that despite the growth in power demand, we have seen merchant power rates dip in the month of November. Now, if you look at the Central Electricity Authority's data points, it clearly shows that the domestic demand remains healthy, especially in rural India. So the overall demand for the country in the month of November grows by nearly 5% according to the data point. More importantly, this is on the back of strong demand in the peak time, which is increased by nearly 7.3%. Of course, on a year-to-date basis, the growth rates have been stronger. Almost 6.3% is the kind of electricity demand uptick that we have seen for the country as a whole for this financial year till date. More importantly, if you look at the region-wise split, the eastern markets have grown by nearly 12%, and this is on the back of strong demand that we have seen from states like Odisha and Bihar, where rural electrification has really taken off well, according to analyst reports. Now, the Odisha power growth, demand growth has been nearly 21%. For the state of Chhattisgarh, it has been 18%, and similar is the kind of growth that we have seen for Bihar. Also, Punjab is one developed state wherein almost 13% growth is seen in electricity consumption. However, as we were mentioning earlier, the plant load factors or the utilization for the companies have declined for key projects that include NTPC's a few projects which have been facing some technical issues. So the PLF growth has been weak, but on an overall basis it has been good since new power plants have come on board. If you look at Adani Mundra power project, the capacity utilization is only 51% versus a level of 65% PLF last year same period. Also, Tata Power's Mundra power plant has seen capacity utilization which is sub 80%. However, if you look at it for players like JSW Vijayanagar plant, CSC Kolkata plant, the PLFs have been more or less stable. However, the question really remains that in order to catch up with the power demand, which is growing significantly in the country, coal production has not been taking off well. In fact, if you look at the Coal India's growth in dispatches for the month of November 2018, the growth has been only 0.7%. The growth last year same period was nearly 10%. So probably the question remains as to how really the coal production is catching up in order to meet that particular power demand, since most of the power plants in India are thermal power plants, and hence Coal India also needs to ramp up their production, and that is something which will play an important role in the coming months for power.
Yes, and thank you so much for that. Let's talk about what's going on at Future Group. Kishore Biyani's family office has raised 3,000 crore to lower debt. Eon Capital Partners has invested about 1,400 crore, while another 980 crore has come in from the Generali Group, hiking its stake in the insurance business to 49%. The brand Skechers is also buying out the Biyani family's 51% stake in the joint venture. Biyani maintains that the deal will not impact the shareholding of any listed company. Aeon will get bonds in the family-controlled central departmental stores. On that note, is out of time on the show. Thank you so much for joining us today.